Welcome to Catalyst. I'm Madison Mills. We're 30 minutes into the U.S. trading day. Let's get you the 3 catalysts we're watching this hour. First up, we'll break down the market rebound as dip buyers emerge from the latest market sell-off. Plus, we'll discuss the state of trade and tariffs with Senator Elizabeth Warren from Massachusetts. And we'll break down how to navigate market volatility as earnings season emerges as the next potential catalyst for stocks. We'll discuss with the CFO of Levi's as its shares pop today. Half an hour into the start of your trading day, let's get you a check on the markets here. You've still got the major averages moving up to the upside. Your S&P up about 3.5% here. Your tech-heavy NASDAQ taking the majority of those gains, up nearly 4%. And interesting to note here, we just heard from Bank of America that they did see clients piling into U.S. stocks as markets did sell off last week, particularly seeing net inflows of $8 billion, the 4th largest weekly inflow based on data going back to 2008. So still seeing evidence of some dip buyers here in this market. But let's look at the bond market. This was fascinating yesterday, seeing the biggest move to the upside in that 30-year yield since March of 2020. And you can see those yields still moving to the upside this morning. And finally, we do want to take a look at one of our risk-off, risk-on indicators here at Yahoo Finance, and that is Bitcoin moving to the upside right alongside equities here, up a little over 2%. Well, stocks are getting a boost after Monday's volatile session. Investors now optimistic as potential trade deals begin to take shape. President Trump saying he had a, quote, great call with South Korea and that China wants to make a deal. So is all of this in the negotiation question in the room going to be enough for a sustained relief rally? Here we've got Nancy Tangler. She is the CEO and Chief Investment Officer at Laffer Tangler Investments. She's going to be my guest host for the hour. We've also got Stephanie Aliaga, JP Morgan Asset Management Global Market Strategist. Thank you both for being on set with me this morning. I really appreciate it. Stephanie, I want to go to you. This bounce, how real is this going to be?
I think we've had a lot of movements in the markets quite quickly. And so just given the degree of volatility that we have right now, it makes sense that we have a little bit of a bounce. We're still in wait and see around further data. And maybe there's some optimism around trade deal. But let's be real, it takes a lot of time to negotiate trade deals. It took NAFTA nearly 5 years, the USMCA nearly 2 years. If we're trying to negotiate all of these bilateral trade agreements across 50 countries, that's likely going to take some time. So I don't think we're nearly out of the woods yet, but it makes sense that we see this kind of bumpiness in the markets.
Nancy, what do you think about today's bounce?
Well, I think the bond market's been telling us, hasn't been panicking, has been telling us that maybe we're not in a recession yet, and we may not go into one. So given that as a backdrop, I do think the noise will continue. So China wants to make a deal. I don't know what that means. And I think that's been the instance throughout this, that's been the case throughout this whole situation. The chart, it's going to take a long time to get over the chart that had all the countries, some of which don't even have people on them. And I think, the interpolated tariffs were a real confidence killer
Totally.
for investors. So let's see how it goes. But we got some earnings today. We got a big buyback announcement. Our case has been that company buybacks were going to put a floor under the stock market. And we saw today that Broadcom has done just that. So we'll see.
So
I'm with Stephanie.
I'm sorry to interrupt you, Nancy. That's such an interesting point because I'm curious if companies do have cash on hand to deploy right now, would they be better suited utilizing that cash to move manufacturing back to the U.S. or to do some buybacks and potentially cushion the stock a little bit?
I think they'd be better served doing buybacks. The moving supply chains or manufacturing back to the U.S. is going to take years, to Stephanie's point. And I think that's the naivete in all of this, that who's going to get hurt? The lower income cohort will get hurt by this. And we're already seeing layoffs being announced at auto manufacturers. Now the administration is floating an export tax credit. So you get your money back at the end of the year if you're a manufacturer in the U.S. I don't see how that raises revenues. Farmers being subsidized. So this has not been well thought out, and I think it's going to continue to morph as we go through, the coming weeks.
And Stephanie, as you look to Q2 earnings season here, what are your expectations, and how does that play into kind of your outlook for the economy as well? Like, what do you think we're going to learn about the health of the consumer this coming cycle?
Absolutely. I think we're set for a real shift in the company guidance this quarter. I mean, at the beginning of the year, we were quite optimistic on the outlook for mid-double-digit earnings growth and quite broad-based earnings growth as well. But now I think what we're going to see is a likely broad-based wave of earnings downgrades and a lot more caution in company guidance moving forward. Because of the uncertainty around the trade front, this uncertainty can be quite paralyzing for businesses figuring out where to invest, how much to invest, who to hire. And I think that's the real risk and something that likely hasn't really catalyzed in the markets just yet.
Yeah. Go ahead, Nick.
Well, so Stephanie, the S&P X Mag 7 is trading at 15 times. But the problem is we don't know, as you point out, what earnings are going to be. And so I'm curious what you're forecasting for earnings on the year and in the first quarter. Because managements, as you point out, have no incentive to give guidance. I would duck if I was the CEO.
Right. Well, right now, consensus expectations have come down from 14% at the start of the year, guided this year, to something around 10.5%. That is around the long-term average of the S&P. And if you think this year is going to be anything like our long-term average when it comes to earnings delivery, I think that's probably a little optimistic. So any kind of forecasting right now is a moving target. It will really depend on the degree of severity of the actual tariffs that are put in place and how long it takes until we get some degree of clarity. But I think that's the real risk.
Mm-hmm. I've been trying to get investor playbooks from everyone as much as I possibly can because there's obviously so much uncertainty right now. So I'm going to ask both of you for your best investment idea in this environment. Stephanie, I know you've been looking global a lot as well. Do you have one specific investment playbook idea for our audience that you think is the best kind of hedge right now?
We've had a long period of U.S. exceptionalism. And when we write our long-term capital market assumptions every year, we've continued to view the long-term outlook, the U.S. exceptionalism likely going to dim a little bit. It's not going to be the only game in town. But what we were missing was any kind of catalyst. Mm-hmm. And we might be seeing that catalyst finally emerge, and particularly for investors that are looking at their portfolios that have only really owned the U.S., this is finally that catalyst to open your eyes and begin to invest and look elsewhere as well. Right. It's not the end of U.S. exceptionalism, but it is a real recalibration that we think will endure.
It's certainly a recalibration. And Nancy, you're going to stick around with us. This is a deep tease for our audience. Stick around to get Nancy's best ideas as well moving forward. Stephanie, thank you so much for joining us. Really appreciate it. Nancy, you're going to stick around. But coming up, a bipartisan effort to limit President Trump's power to impose tariffs. Massachusetts Senator Elizabeth Warren joins me next with more on the future of the Trade Review Act of 2025. That's next. Lawmakers on Capitol Hill are looking to limit President Trump's power to impose tariffs. A newly proposed bipartisan bill known as the Trade Review Act of 2025 would require the president to notify Congress of new tariffs within 48 hours, would give Congress 60 days to approve those tariffs and the ability to end them at any time. Here with more, we've got Democratic Senator from Massachusetts, Elizabeth Warren. Senator Warren, thank you for making the time. You are calling on Congress to stop these tariffs, but the president has already come out planning to veto any congressional action, and you still don't have full bipartisan support. Is there a veto-proof measure that you could realistically accomplish on tariffs?
Well, so let's remember, I very much appreciate that right now there are Republicans as well as Democrats who are saying that what Donald Trump is doing with tariffs is a disaster, not good for our economy, not good for American families. So the question is, what can we do together? You know, there's already legislative authority for Congress to roll back the emergency declaration that Donald Trump has made. And if we use that legislative authority, then the tariffs are no longer in place. We can do that. We can do it quickly. And I think it's what we ought to do right now.
What are you hearing from your Republican counterparts in Congress about how they are hearing from their own constituents on the potential impact of tariffs and how that impacts their likelihood to join you on this?
You know, I'm not hearing from anyone in Congress, Republican or Democrat, who are hearing from people back home that Donald Trump's tariff announcements have been good for them. Let's face it, this kind of across-the-board tariffs, not thought through, not to protect a particular industry or to onshore a particular supply chain, not brought in over time, but instead just this massive shift. This is something that the chairman of the Federal Reserve has already said is going to drive up costs for families through inflation and drive up unemployment simultaneously. And families are really, really worried about that. They're also worried because they're already seeing prices go up. There are already those companies that are announcing, oh, tariffs are coming, so we're raising our prices right now. Let's face it, this is just a form of price gouging. And what the tariffs permit companies to do is when everyone's talking about prices going up, they get to raise their prices not just to pass along costs, but they get to raise their prices just to boost profits because they think they can get away with it. That's going to be really tough on American consumers, and they're pretty upset about it, and they're letting their representatives and their senators know about that.
So, Senator Warren, help me understand the extent to which you feel that you will be able to successfully bring back congressional authority over tariffs. Obviously, the president had utilized IEEPA, talking about how these tariffs required some sort of emergency economic power. Do you think one of your tools that may be more effective is Congress proving that there was, in fact, no emergency here?
In fact, that's what IEEPA requires, right? It permits Congress, it gives Congress already a role. You're right to focus on that statute. And it gives us the power just to come in and vote and say there is no emergency. And remember, last Wednesday, that's when we saw the first crack in the Trump Republican senators' wall. And that was that Democrats introduced a bill. Remember, at that point, we only had the tariffs against Canada and Mexico. Introduced the bill saying we are not in an emergency with Canada. And that would have rolled back those tariffs. And not only did all the Democrats vote in favor of that, we had 4 Republicans cross the aisle so that a majority in the Senate have already voted to say no to the tariffs with Canada. Now, we need the House of Representatives to do the same, but the bill is there. It's now pending, this resolution. It's not even a bill, this resolution under existing statutory authority. So this is a moment when pressure from back home, from all those small businesses who are worried about what's going to happen to their own costs or whether or not consumers are going to be able to buy their products. Pressures from families saying they're worried about costs going up or about losing their jobs.
And so, Senator,
this is the moment we could see a change
given all
Republicans.
And given all those challenges that you lay out, one body that does have emergency power right now is the Federal Reserve. Do you think the Fed should come in with an intermeeting cut?
Well, the problem the Fed's got is that it's being pulled in 2 directions at once. On the one hand, we're watching markets go down. But on the other, the Fed is saying they're very worried that inflation will go up and simultaneously that unemployment will go up. Remember, the Fed has very limited tools, and an interest rate reduction at this point may play in to the right place on jobs, but if it's pulling the other way on inflation, I think they've got a really hard path in front of them. And that's the problem you get into when it's chaos. And that's what it is that the president of the United States has created. You know, this is the dumbest trade war in history. And this is a potential recession created not because we had years of building up risk in the financial system as we did in 2008, or because there's been a war. Instead, this is one person creating enough chaos that it may bring down not just the American economy, but the worldwide economy.
And Senator, are you concerned about a bank run given all that chaos?
Well, again, it's how far out this is going to echo. And yes, as people start to have to ratchet back on their investments, as they have to start selling off assets to meet margin calls, then you start to worry. Are the banks in a steady place? And this is where the Secretary of Treasury needs to act more aggressively. Yesterday he was talking about how all these people that Donald Trump and Elon Musk have illegally fired, they'll go work in the factories. Well, those factories aren't built. In the real world, that simply is not possible right now. Instead of engaging in that kind of fantasy talk, he should be convening the FSOC, the oversight that we have, the oversight committee, and it should be right now pulling all of the economic leaders throughout government together and working on a plan to make sure that our entire financial system is secure. But right now, the Secretary of Treasury just seems to be off on a sales pitch rather than actually doing his job of convening FSOC and making sure that our entire economy at least holds off as much of the damage as possible.
And Treasury Secretary Besson is meeting with Jamieson Greer with USTR. They're going to be speaking with Japan about a potential deal. If deals are made, markets are going to potentially rally off of that. Is deal making sufficient in your view on tariff policy?
Look, much of the damage is already underway. Because if Donald Trump says he goes for a deal today, is anyone confident he'll be on that same deal tomorrow or the next day or the next day? Who makes an investment that will take 20 years to amortize? Who builds a factory based on having a pretty clear understanding of what the international trade picture looks like at a time when Donald Trump is saying over here, over there? The tariffs will be this big, no, this big, this big, this big. Uncertainty does not help create investment here in the United States or anywhere else around the world. And that's the real problem. Donald Trump is out there just shooting wildly. And that's bad for American families, bad for the American economy.
And Senator, I want to end with your message to constituents who are concerned about their 401ks, who are even concerned about missed Social Security payments. What would you tell them?
I would tell them to remember that right now, Congress has power and that Congress can roll these tariffs back and steady this economy out. But it's going to take Republican support to make that happen. The laws are in place. We just need to vote to make that happen. So let your senators, let your representatives hear from you. If you want those tariffs leveled out, you want to have something steady, make those phone calls, send those emails, send those texts. Now is the time.
Senator Warren, thank you so much for making the time for Yahoo Finance. Really appreciate it.
Thank you.
We're going to have all your markets action ahead, so stick around. You're watching Catalysts.
Recent volatility has brought renewed focus on a little-used market mechanism that was born out of the 1987 Black Monday stock market crash. I'm Jared Blickery, host of Stocks in Translation, and today we're going to break down circuit breakers. So let's go to the definition first. A market circuit breaker is something that temporarily pauses trading during rapid market declines, helping investors calm down and preventing panic selling. That's the theory anyway. And let me go over some of the thresholds that have to be met. We're talking about the S&P 500 here, which is the benchmark for the United States stock market. A level 1 decline happens if the stock market drops 7%, and it is then halted for 15 minutes. If it happens after 3:25 p.m., so if you drop 7% by 3:30 p.m., you just continue to the end of the trading day. Level 2 is a little bit more serious. If you drop 13%, you halt another 15 minutes. And if it happens before 3:25, that is the case. If it happens after, you do not halt at all. Now, if you go down 20%, which could happen just after 30 minutes if you have 2 prior trading halts, if it's 10 a.m. and you go down 20%, you close up shop for the rest of the day. Same thing. If it's 3:59, you close up shop for that 1 extra minute, and you don't have any time constraint with that level 3 drop. Now, we have seen a few of these play out. And as I mentioned in the beginning, this was born out of the 1987 Black October market crash. And so we have October 27, 1997, 2:35 p.m. We got that very first one. And guess what? The full day return that day was down 7.2%. So if you remember our other slide, it was 7% down. That was the threshold. And we managed to close a little bit off of that into the close that day. Then we didn't see them for another, 23 years? It was the depths of the pandemic, and on March 9th, it was a Monday in 2020, I remember it well, 9:34 a.m., we got another circuit breaker. That day, we ended up down 7.6%. Then a few days later, we got another one at 9:35. We were down 9.5% that day. Then the next week, we were down at 9:30 a.m. The market opened, and just at like that, 7% down, the market closed just seconds after opening. That day, the market was down 12%. And then just a couple days later, we got the last in the series. That happened at roughly 1 p.m., 12:56 p.m., and we ended up down a little bit less than 7% that day, down 5.2%. So we'll never know what the experience would have been like without these circuit breakers, but I should also mention that we have these for individual stocks. They're called limit up, limit down, and we saw a lot of these not only in the pandemic, but also in the GameStop Reddit phenomenon that went in the year after that. So you can have circuit breakers in individual stocks, and it depends on their dollar amount and how much they're moving, as well as the index at whole. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Thanks, Jared. Well, tech stocks are leading the market rebound today as dip buyers emerge from the market sell-off. Stocks now on pace for their best day in 3 years. Joining us now with more, Dan Niles, the founder and portfolio manager at Niles Investment Management, and still with us, Nancy Tangler of Laffer Tangler Investments. Dan, thank you so much for being here this morning. So taking a look at this short-term bounce, do you think that this has legs, or are you still cautious even amid this bounce?
No, I mean, I said in an interview yesterday, I thought you could have a bounce and it could continue for a bit, because even during the worst declines that are structural, so if you go back to the global financial crisis, you had 11 rallies in the S&P 500 of 10% each on your way to losing 57% of your money from peak to trough. And this is a very consistent pattern, no matter if you look at that, or you look at, during COVID, which was very short, or you go all the way back to the tech bubble, you have these vicious counter trend rallies because people think that, oh, everything is sorted out, you get double digit gains, and then you give it all back. And the biggest issue I have from the longer term, and why I came into the year, if you remember, I had cash as my lead pick for the year, was that valuations to start the year were really high at 25 times on the S&P on a trailing basis. And earnings estimates had actually started to go down for the S&P from the middle of last year, which nobody cares about when the market's going up and the Fed's cutting rates, and you can invent, how big AI is going to be a decade from now. But then, when you run into a period of turbulence, people start to focus on things like earnings and PE ratios.
Mm-hmm. And Nancy, I want to bring you into the conversation. Do you think that this bounce we're seeing is somewhat of a euphoria around the negotiation headlines that we're seeing, negotiations with Japan? We just saw a report about Treasury Secretary Bessent urging Trump to lean into the negotiations. Is that kind of sentiment around deal making going to be enough to withhold this bounce?
I think so. I do think you're right that the market is responding to some clarity because we've had none. Mm-hmm. And I think that it's going to benefit the growth names if we can get this resolved sooner rather than later. So it's so hard in the day-to-day mm-hmm. to come away with a real sense of certainty, because I think I agreed with Senator Warren for the very first time, or at least one of the first times. The uncertainty has been ridiculous and unnecessary. So congrats to Dan on his cash call. I'm just wondering if he's willing to put some of that money to work now.
Well, Dan, let's hear from you. Are you putting any of that cash to work at this moment?
Yeah, I actually started doing that yesterday. I actually do not have any shorts as of yesterday because I covered them all. Actually, that's not true. The one short I do have is a volatility short, in that I expected volatility to start to drop because I thought the market would start to rally. So I have started to put that to work yesterday. I'm putting more to work today on the names that I think actually are going to have good earnings and good outlooks. And those will be names in the networking sector where the way I thought about it big picture, because remember, I came into this year and I was negative on the Magnificent Seven. I had no Magnificent Seven stocks in my top picks for the first time in years because I thought they were going to have earnings issues. And if you remember, 6 of the 7 Magnificent Seven stocks, when they reported their calendar Q4 numbers, they had the revenue estimates for calendar Q1 go down. So these stocks were already down 6% at the end of February, while the S&P was still up 1%. So this is an earnings issue for those names and a multiple issue. But if you look at areas like networking, I think what you're going to see this year is as you're going through an AI digestion phase and companies are starting to slow down their spending on AI infrastructure, well, you still have to move all that data around inside corporations. You still have to get access to that data. And a lot of those stocks have been given up for dead for the last couple of years on both the telecom side, where we recommended Adtran, as well as on the corporate side, where we recommended Cisco. And I think both of those will actually have pretty solid earnings going through this year.
Yeah, Dan, so this is Nancy Tengler. So I wondered, primarily, are you deploying assets internationally or globally?
Yeah, I mean, at the beginning of last year, I picked KWeb as one of my top 5 picks. And obviously last year, it did terribly relatively. It was only up about 8%. If you look at it this year, what I tell people is everybody thinks, oh, there's a hatred for tech stocks. Well, no, there's a hatred for U.S. tech stocks because the Mag 7 are down 20% year to date, but KWeb's actually up 3%. And the reason is really simple, which is if you go look at China, valuations for a lot of the top AI plays in China are at half or a third of the valuation levels that is out here for U.S. companies. And I think what DeepSeek showed people was that yes, China is behind. It's not like they came up with ChatGPT,
right.
But DeepSeek had some really great innovations in it and it's open source. So US companies are starting to use those innovations to make US, large language models that much better. And so I am definitely looking overseas because I think, the big thing you're seeing is you sort of had this view over the last several years, the US is the only place you can invest. And I think valuations got out of control even as estimates started to go down. Because as I said earlier, Microsoft, Google, and Amazon all had estimates for the September quarter of last year get cut when they reported the June quarter. So this has been going on for a while. Mm-hmm. Now what happens is you get a catalyst and people go, well, maybe the China tech stocks are kind of interesting because those estimates are actually going up again for the first time in several years. Yeah. And so that's kind of where I'm looking, Nancy.
So, great. Dan, really quickly here, how are you viewing KWeb versus any sort of dip buying opportunity in U.S. Mag 7 stocks? Would you still be more interested in piling more cash into KWeb?
Well, let me be clear. I don't own that right now. I look at components within that, but that's just an internet index that gives you an idea of what's in there, right? It's like NASDAQ or whatever in the U.S., however you want to look at it. But I think I'm an earnings-driven guy, and I'm a risk-averse guy. So I like good risk-adjusted returns. And if you look at the Nasdaq, the Mag 7 names as an abbreviation, when you've got estimates coming down from the middle of last year, and 6 of the 7 have estimates coming down when they reported their December quarters, it doesn't make you feel really good when this was happening before you had all of this turmoil, right? And we can walk through each one of those names, but you've got advertising related stuff in there that could potentially get hurt when they report. Obviously, Apple's pushed out, Siri into next year in terms of the AI upgrades. And, Amazon's obviously retail oriented if you're worried about a recession. So you can walk through all of them. And Microsoft has had forward numbers come down for 9 months in a row. So each of them's got their own set of problems going on, where at least when I'm looking overseas at China, I go, really, since the Ant Financial IPO got blocked in, I think it was November of 2020, if I remember correctly, or December, those stocks have been horrible. But their government has actually turned around and started to support their companies put out stimulus, which is the exact opposite of what's happening in the U.S., where Doge is focused on getting government waste out, getting the deficit under control. So you've got two very different economies working at the same time.
Dan, thanks so much. Really appreciate you joining us. Nancy, I want to bring you back into the conversation. So my question there, and I'm not sure if I said it inaccurately or if there was a misunderstanding, but I was curious, what's the better investment idea, K-Web or looking at Chinese tech versus buying any dip in Mag 7 names? How are you thinking about that?
Yeah, so when you have a government that can shut down entire industries like in China, it has to be a trade.
Yeah.
And we don't necessarily trade for our clients, we're more long-term investors.
Right.
So we've actually been adding to some of the names that Dan doesn't like. And I think, that's what makes a market, right? So we were adding to tech in the summer of 2022, and we're really happy we did that because we got the ChatGPT announcement in the fall, and that worked out pretty well. So I think we've been very deliberate and slow, but we've shifted our focus in AI to software, and we did that about 6 to 9 months ago. And we added names like Palantir and CrowdStrike. Cybersecurity is a big, important position for us. And then we added to Microsoft just recently. We added to NVIDIA not too long ago. And we've been a big owner of Broadcom, what we call the poor man's NVIDIA. And that's been a good place to be.
Yeah.
So I think, if your time horizon is 1 year, and I think his is, what he's doing makes sense. But for us, we have taxable clients, they have long-term objectives, and I just find it's a better way to invest for my disposition. So we go out 3 to 5 years, and I think you're going to want to own these names in the next 3 to 5 years, because the AI phenomenon is just getting started, in my view.
Really great overview, Nancy. Thank you so much. Appreciate it. We're going to have more coverage ahead on what tariffs could mean for your favorite pair of jeans with the Levi Strauss CFO. That's next. Let's get a check-in on Levi's shares continuing their move to the upside this morning after topping first quarter earnings expectations and maintaining full-year forecasts. The jeans maker excluding the effects of President Trump's tariffs, with executives saying they anticipate a minimal impact near term. Still, the company says it may be required to modify sourcing practices, which could impact product costs. Joining us now, Harmeet Singh. He is Levi Strauss's Chief Financial and Growth Officer. Harmeet, it's great to speak with you. So you are keeping your forecast, but you said that it assumes no deterioration in the macro environment. Can guidance be guidance right now if it does not include the impact of tariffs?
Good morning. Thanks for having me here. As you know, we reported a very strong start to the year. Our quarter one beat top line and bottom line expectations. Organic revenue accelerated. We were up 9%. Our EBIT margins expanded and were up 400 basis points, and EPS was up 52%. So overall, a real strong start to the year. Our transformation strategies are working as we pivot to a DTC first lifestyle company. Our DTC results, which is direct to consumer, which includes our stores and e-commerce. It was up 12%, 12 consecutive quarter of growth, and what I like to call a trifecta, which is, we're growing comp sales, we're adding profitable new stores, and we're growing e-commerce. And so, a real strong start to the year and good momentum. To your question about guidance, Madison, it's early days. Yes, the tariff that were imposed have created more uncertainty. We are best positioned to navigate it. The situation is very fluid. And the way we think of guidance is it's important to give expectations when we are clear about the expectations. We are very clear about quarter two, and we guided quarter two, which is again, growing 3.5% to 4.5% on an organic basis. Gross margins continue to improve, and we guided our EPS expectations. And so that's the reason we stuck with the full year guidance. Just before the announcements of tariffs, given the results we had in Q1, we were debating whether we should take up full year guidance. But given that it's just the beginning of the year, and then the announcement on the tariffs, we felt prudent at this stage to maintain our full year guidance.
Understood. So I know that you've also, as part of that, introduced a tariff task force internally. Our sourcing indicates that some items that you have could increase their cost by as much as 100%. Does that feel accurate to you?
Not entirely, only because if you think of our supply chain, yes, so first we have got a task force. The task force is working 24/7. It's how we have managed other, previous crises, and we've actually, being a company that's been around 170 years, we have navigated through them, emerged stronger post the crisis. The task force is really looking at all options. They're looking at cost management options. They're looking at how we manage and talk to our different stakeholders, customers, our vendors, who we have long tenured relationships, and also looking at pricing options, from that perspective. To your question about a diversified supply chain, we source from 28 different countries, and not any country makes up more than 25% of what we source from. Into the US, we source from 20 countries. We have the product already for spring and summer, and that's why we were very clear about expectations for Q2.
Harmeet, this is Nancy Tangler. I'm a native San Franciscan, so Levi holds a very special place in my heart. But I'm wondering if you anticipate any retaliatory demand issues from some of our trading partners.
Nancy, we haven't seen any retaliatory pushback from consumers. As a brand, we've been present internationally for over 80 years. We have deep connections with the consumers. We are an American brand with a global presence, and 60% of our business is overseas. And so, as far as we are seeing, international, as an example, was up 9%. 75% of the apparel market is outside the US, and we are connecting really well with the consumers globally.
All right, Harmeet, we have to leave it there. Thank you so much for joining us. Really appreciate it.
Thanks, folks.
Of course. And Nancy, I do want to go to you on retail because I'm so used to talking to you about tech stocks, but I know you recently added to TJX. Talk to me about that play.
Well, it's they have 100, so they're sourced from 100 different countries, and that could get dicey, but I think it gives them flexibility. They just raised the dividend 13%. So the management, and this was before the tariff announcement got liberated, shall we say. And so they have indicated that they believe earnings through the dividend increase, that they think earnings are sustainable. They're just the best in class, and their consumer is a little bit higher end. We've also talked about Walmart in the past, which is one of our names, and Home Depot. And so we trimmed back a little Home Depot and added more to TJX. So I think the trick is going to be whether or not these companies can continue to sell in China. And we've seen from Starbucks and Nike that maybe there's some valid concerns around that. So it'll be a challenge, but I think TJ Maxx is one of the best managed retailers.
Are you worried about Walmart at all?
I'm not worried about Walmart. I do own Starbucks, and it's pretty much given back everything that it gained after Brian Niccol joined. So I expect they're going to come up with a creative China strategy, which may include franchising. But we'll see. Like he said, Harmeet's not willing to give guidance. I wouldn't be either if I was the CEO. You've got to wait and see how this thing settles in. And whether or not Elizabeth Warren wins the battle on legislation. So
certainly a lot of uncertainty. That seems like the only thing we know at the moment. Nancy, thank you so much. Stick with us for more. We're going to have all your markets action ahead, so stick around. President Trump's reciprocal tariffs set to go into effect Wednesday, April 9th, would bring import taxes to the highest level for the U.S. since 1930. The Smoot-Hawley Tariff Act, enacted by President Herbert Hoover in 1930, came months into the Great Depression. Designed to protect American farmers and manufacturers, these tariffs instead kicked off retaliation from U.S. trade partners, bringing global trade to a standstill. The tariffs were renegotiated under President Franklin Roosevelt in 1934. So far, multiple nations have expressed a desire to negotiate with the U.S. on these tariffs. And according to our next guest, tariffs don't necessarily mean tough economic times ahead. Joining us now, Greg Ip, the Wall Street Journal's chief economic commentator. Greg, great to speak with you here. Talk to me about your reporting in terms of, I feel like the Smoot-Hawley Tariff Act has never been more popular, at least for my generation. How is that different than the tariffs we're seeing right now in terms of it potentially being an economic indicator of a slowdown to come?
Yeah, and Madison, if you haven't seen the movie Ferris Bueller's Day Off, I recommend that you do go see it. And then you would actually be able to answer the question, what is the Smoot-Hawley Tariff Act? For any historian who has looked at the Great Depression, they know that this was a dramatic increase in tariffs passed by the Congress, signed into law by Herbert Hoover in 1930. They know what came after that. There was a collapse in worldwide trade as other countries retaliated, and the United States and the world slid into depression. So pretty grim kind of template for the present, right? In fact, little known fact, Trump's tariffs are actually much higher than the Smoot-Hawley Tariff Act. But but the point I want to make here is it doesn't necessarily mean we have to repeat the 1930s. So it all depends on what comes after. The reason other countries retaliated in the 1930s was because the U.S. was dug in on these tariffs and the entire atmosphere of cooperation disintegrated. If instead we have negotiations and a sense that we can actually dial them back, I think the outcome will also be different.
Greg, this is Nancy Tangler. I feel like all my economic education has come from reading you in the Wall Street Journal. So thanks for all your years of
Thank you.
Great reporting and editorializing. But I did want to ask you, so maybe this is one of the things that comes after, but we're already hearing the administration float some help for farmers and also a potential export tax credit where you get your money, your penalties back at the end of the year if you're a manufacturer. What do you make of that? Do you think those are real policy proposals, and do you think that is one of the things that comes after that may make this more palatable?
Those are things. Well, I think you have to frame those as the administration shoring up their base. They're very worried that Republicans and traditional Republican constituencies like farmers and so on will start to turn against the tariffs, put pressure on their own senators and congressmen to turn against the tariffs. These steps might help politically, but they will have almost no effect economically. That's because the scale of these tariffs is so enormous. I mean, we're talking about $500 billion a year in added fees, primarily borne by Americans. And that dollar number, Nancy, doesn't do justice to how distorting and damaging they are to the overall structure of the American economy, which has built supply chains and relationships for years around the assumption that the United States would be importing a lot of these products. So you can't simply say, oh, well, we're going to raise tariffs by $1, but we'll cut income taxes by $1 and it will all be good. No, it won't be like that.
So, Greg, where does that leave us in terms of especially the Trump administration's talking points about the positive impact of these tariffs on things like the job market, bringing back manufacturing jobs? What economic impact could that shift potentially have?
So I think it is definitely the case that you will get some jobs created in the United States to make the products that we're no longer importing. I would be shocked if that didn't happen. I think the question is, will the overall economy be healthier as a result of it? Certainly, most economists don't think so. But one of the reasons nobody wants to basically plant a flag and say with a great conviction that the economy will be great or will be terrible is because we're still trying to figure out what Trump's end game is here. Does he really intend like these 20 percentage point higher tariffs to be permanent forever? That's a very negative outlook. Or does he really intend this to be a starting point to negotiate? Like, talk to me, Japan, talk to me, Israel, talk to me, Mexico, Canada, Europe, and we'll come to some agreement that lowers these tariffs. That's a very different outcome. And that's why I return to my original point. If these tariffs result in negotiation, then that's a generally benign outcome. If they result in just retaliation after retaliation, that's a very malign outcome.
Yeah. Greg, thank you so much. Really appreciate you making the time. Nancy, I do want to join you here. You were saying the exact same thing to me, that the challenge is that we don't know the end goal.
Yeah. And I think one of the things they've underestimated is if you look at manufacturing GDP, 68% of parts are imported in. So how is that accounted for? And so I'm hopeful that Greg's right, that what we are seeing is an art of the deal in real time in the public square. I'd rather we do it behind closed doors, and I think the market would too. Yeah. But yeah, I think that is the question. What's the motivation?
That is certainly the question. Nancy, thank you so much for joining me for the hour. Really appreciate it. Excited to have you back as soon as you're willing to fly back to New York with us. Really appreciate your time.
Maddie.
Thank you. Coming up, we've got Wealth dedicated to all your personal finance needs. Brad Smith is going to have you for the hour, so stay tuned for more.